Let's talk seller-paid buydowns. What are they and how can they help? But first, let me share. The primary purpose of this podcast series is to inform, entertain, and educate. The information, opinions, and recommendations presented in this podcast series do not constitute legal or other professional advice, opinions, or endorsements of any kind. Welcome to the Martini Mortgage Podcast, episode 159. My name is Kevin Martini, and I am a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446. Equal housing lender. Woo! Now that that's out of the way, let's talk about the elephant in the room. Mortgage rates. Specifically, the rise in mortgage rates. At the time of this recording, mortgage rates are at a 52-week high. And the market experts are divided. Some think mortgage interest rates are going to remain at this level for the balance of the year. And others believe home loan rates are going higher this year. This rising mortgage rate environment has caused mortgage payments to increase to a level not seen for over decades. But remember, rents have also increased dramatically too. On the aggregate, shelter is getting more expensive. Right now, this current real estate market is putting pressure on potential home buyers, and seller-paid buydowns may be the tool to help not just home buyers today, but also home sellers too. Before I discuss how home buyers and home sellers can benefit from buydowns, let me share with you what a buydown is. A buydown is where the seller pays a fee at closing to reduce the interest rate on the buyer's mortgage temporarily. A buydown results in a temporarily lowering the buyer's monthly payment and making the home more affordable for home buyers. There are 3 seller-paid buydown strategies offered by the Martini Mortgage Group, and they are the 1-1 buydown, the 2-1 buydown, and the 3-2-1 buydown. With a 1-1 buydown, the seller pays a fee at closing to reduce the interest rate on the home buyer's mortgage by 1% in the first year. With a 2-1 buydown, the seller pays a fee at closing to reduce the interest rate on the buyer's mortgage by 2% in year 1 and 1% in year 2. With the 3-2-1 buydown, the seller pays a fee at closing to reduce the interest rate on the buyer's mortgage by 3% in year 1, 2% in year 2, and 1% in year 3. Let's talk the benefits. For a home buyer, with a buydown, it reduces the buyer's interest rate and monthly payment during the first few years of home ownership. This makes the home more affordable for home buyers. It has a much greater impact on the home buyer's monthly payment than reducing the list price of the home. Let me say it again for the people in the back. A seller-paid buydown has a greater impact on the home buyer's monthly payment than reducing the list price of the home. The home buyer is not the only one that can benefit from a buydown. A home seller can, because buydowns could be a great negotiation tool, because a greater percentage of homes listed for sale in today's market, which is shifting to a more normalized market, are seeing price reductions. Not only does a buydown make the home more affordable to a wider range of buyers who may have otherwise been priced out of the market, it also tends to cost less than a price reduction. A seller offering to pay a buydown could provide a competitive advantage versus other homes listed for sale in today's changing market. This is because interest rates have gone up significantly this year, creating an affordability crisis for many potential home buyers. As an added benefit, a buy down could also save the seller the aggravation and the financial loss of having to significantly reduce their list price in order to compete with other homes that may be listed for a lower price. Let me be transparent. This market is returning to a normal market with some challenges, and one of those challenges is low inventory. And then pepper in fluctuating upward mortgage rates. Sure, inventories of homes for sales have increased, but homes for sale remain a challenge. Let me get granular on inventory. The number of homes listed for sale has increased in 2022 versus how it was in earlier 2022. However, housing inventory is still below historical averages due to the real housing shortage we have in the U.S. Both Freddie Mac and the National Association of Realtors estimate that we're still currently short between 3 to 5 million homes in the U.S. due to underbuilding during the past decade and rising demand among first-time homebuyers. Oh, by the way, it's not going to take months or years to resolve this housing inventory. It could take a decade plus. Here are 2 Martini Mortgage Group ideas to help home sellers and home buyers. If you are a home seller, price your home right the first time around. You don't want to overprice it and miss the opportunity to sell it quickly. If your home sits in the market for too long, buyers start wondering what's wrong with it, and you'll miss a chance to get a good price and terms. If you're a home seller, you should consider offering a buy down strategy to the home buyers that are looking at it. If you're a home buyer, you must be prepared to act quickly, turbo fast, if you find a home that you like. In order to act turbo fast, you must be fully approved in advance of finding that home. Yes, in any market, especially this current market, it needs to be home loan first and then go find your home. With the Martini Mortgage Group, we offer the families we serve with a same as cash approval. So the families we serve are able to communicate to a seller that they are not just ready and willing, they are ready, willing, and able to buy that home. In addition to making a same as cash offer, the families the Martini Mortgage Group serve are provided with price and cost clarity so that when the right home is found, the offer can include the proper mortgage strategy to provide one with the lowest cost of borrowing. A seller-funded buydown may be the right strategy. Let me share an audio example for illustration only on the power of a seller-funded 1-1 buydown. For conversation purposes only, let's assume the purchase price of $400,000 and the home buyer is putting 20% down and securing a 30-year fixed mortgage at 7%. Again, let me highlight that this is only for illustration purposes only. Again, if a home buyer purchases a $400,000 home and put 20% down with a 30-year fixed rate of 7%, they would have a principal and interest payment of $2,128.97. If the seller offered or the home buyer requested a seller-funded 1-1 buydown, the rate would be reduced by 1% for the first year. In other words, that 7% would go to 6%. The principal and interest for the first year would be $1,918.56. And that is a savings of $210.41. For the first 12 months, that homeowner is in that home. Yes, a seller-funded buydown is a very powerful program, and it truly helps both home buyers and home sellers. Oh, by the way, you can use a seller-funded buydown with the Martini Mortgage Group with our low down payment options. You can use it with conventional loans, FHA loans, VA home loans. And then another amazing benefit is if there's an unused portion of the buy down, that unused buy down credit is available when you sell the home or refinance the home, and it is credited back to the home buyer. I'm a certified mortgage advisor, and as a certified mortgage advisor, I refer to the seller-funded buydown as a quasi-asset, because if there's an unused portion available at the time of sale or time of refinance, it is returned to you, the home buyer. We have to look at history to fully understand why this, what I call a quasi-asset, is so very important. As a primer, it is my opinion at the time of this recording, based on the data, that we are in a recession. Let me first start by saying a recession does not mean housing crisis. A recession is simply a slowdown of the economic activity, and it's part of a normal, healthy economy. In modern history, in the U.S., we have seen 6 recessions. In 6 out of the last 6 recessions, mortgage rates have improved 2.35%. Please know the past is not indicative of the future. However, 6 out of 6 times there was a recession, from peak to trough, mortgage rates improved, on average, 2.35%. In my experience, the Fed is the last one to the party, and it's also the last one to leave the party. They will get inflation under control. And remember that inflation is the nemesis to bonds. And that is significant because bonds are where mortgage rates live. Experts predict mortgage rates to drop next year. In fact, Fannie Mae is projecting mortgage rates in the 4s in 2023. It is my opinion this drop will happen towards the end of 2023 or beginning of 2024. And if my thesis is proper, the home loan secured today will be refinanced at that point. Simply put, the seller-paid buy-down strategy allows one to marry the home they want today and rent the rate for the home at below market rates, with the very possible prospect to refinance in the future while having a quasi-asset to unleash. In closing, in today's market, both sellers and buyers need to evaluate the best approach. A seller-funded buydown as a 1-1 or a 2-1 or even a 3-2-1 might just be the right approach to consider. Remember, it should always be home loan first and then go find your home. For more information about the seller-funded buydown or anything real estate or mortgage related, I invite you to call a mortgage strategist with the Martini Mortgage Group by dialing 919-238-4934. Thank you for tuning in to episode 159 of the Martini Mortgage Podcast, and please share it with someone you care about that could benefit.